application of direct tax law, chapter name, tax directorate code and tax collectorate code. This starts from section 190 to section 196, tax directorate code, section 190. Section 190 tells us what? Section 190 tells us what is the amount of tax that is deducted. Means the after we start with the introduction that the income of the person in the previous year will be taxed in the assessment year. Okay, where the government is going to collect the tax from the person in the previous year itself in the form of four types. First type is tax deducted at source, means the income that is arising from the source itself, the tax is going to be deducted. And second one is tax collected at source, means the income that is arising from the source itself, the tax is going to be collected. Third one is advance tax, where the person has to estimate the amount of tax that he is going to be and in the financial year or in the previous year, and he has to estimate the tax liability and he has to pay the amount of tax liability to the government in the quarterly basis. Fourth one is amount of tax that the employer is going to pay under section 192 subsection 192 subsection 1 capital A on the tax on non-monetary perquisites that are provided to the employees. Non-monetary perquisites means what? Non-monetary perquisites means the perquisites which are not in a monetary form. The tax it is going to be the benefit for the employees, and another benefit is the employer itself is going to pay the tax on non-monetary perquisites other than employee. Employee is not going to pay the tax, but this is going to be the tax of this is going to be the benefit, the tax that is going the tax that is paid by the employer on behalf of employees is going to be the benefit for the employees, and it is it is going to be the income of the employees. But there are two things for this. First thing is two limbs. First limb is whatever the tax that has been paid by the employer to the government is going to be disallowed under section 40 capital A subsection 5. So this is not going to be in the eligible expense for the employee for the employer. Means he cannot claim it as eligible expense while computing his PGBP income. It is going to be disallowed under section 40 capital A subsection 5. Second thing is here whatever the tax that has paid by the employer on tax on non-monetary purposes is going to be the income for the employees, and it is going to be taxable in hands of employees. Okay, and this is going to be exempt under 10 subsection 10 CC. It is going to be exempt in the hands of employees under section 10 subsection 10 CC. Next, second one is whatever the tax that has paid by the employer on the non-monetary purposes can be claimed as can be claimed as a rebate, or we can say benefits. We can claim it as benefit credit against the tax payable by the employees while furnishing their return of income. This is the tax. Now here there will come the circumstance that if the person has not deducted the tax, or he has deducted the tax but he has not paid the tax to the government within the specified time limit, then what are the consequences? So, under income tax, there are some of the consequences that have been prescribed. First thing is, if it is an eligible expense and the amount of against that amount of expense, the type of expense we can say there are two types of expenses: expenses that are incurred for the residents and expenses that are incurred against the non-residents. If the expenses are incurred against the residents, then if the tax has not been deducted, then in that situation, 30% of that expense is going to be disallowed for the previous year. Means 30% of the expense cannot be claimed against the income while computing PGBP by the assessee. Now, the expense that is made against the non-resident. If tax has not been deducted or tax deducted but has not been paid to the government before the filing of return of income, then in that situation, whatever the amount of payment that has been made by the employer is going to be 100% disallowed. He cannot claim it as expense in the PGBP profit and loss account while computing PBUC income. Third one is third type of expenses. It can be an equalization levy where amount is going to be paid by the assessee to the non-resident. Then he has to deduct equalization levy. If he fails to deduct equalization levy, then also 100% of the amount will be disallowed. He cannot claim it as expense while computing PBUC income. Next, third case is he will be considered as assessee in case of default. What is the meaning of assessee in case of default? Assessee in case of default has been defined under section 2 subsection 221 sub 2 not 1 sorry 2 not 1 2 not 1. So section 2 not 1 capital subsection 1 tells us meaning of assessee in case of default. Assessee in case of default means the person who has deducted the who hasn't deducted the tax or who hasn't paid the tax or the who hasn't deducted who has deducted the tax but hasn't paid the tax to the government. These three consequences, if the person encounters these three consequences, then in the situation the person will be considered as what assessee in case of default. Now, if the person is the person has encountered any one of the consequences and he is considered as assessee in case of default, then what are the consequences that will arise for the assessee? Consequences are he will be liable to penalty. He will not be liable to penalty under section 221 subsection 1, and he is liable to interest. He is liable to interest and he has to pay the interest. And third one is third consequence is what? Third consequence is he will be interest. He is liable to pay the interest. So here the thing is interest is going to be paid. Interest is going to be paid in two consequences. First consequence is the person hasn't deducted the tax and hasn't paid the tax to the government. The person has deducted the tax but hasn't paid the tax to the government. If the person has not deducted the tax and has not paid the tax to the government, then 1% per month or part of the month from the date onwards it is deductible but not deducted to the date onwards to the up to the date where the tax has been deducted. For that period, he has to pay the interest at the rate of 1% per month or part of the month. Now, second consequence is the person has deducted the tax but not paid the tax to the government. Then in the situation, the person has to pay interest at the rate of 1.5% per month or part of the month from the date onwards the tax has been deducted, but till the date onwards the tax hasn't paid to the government. He has actually paid to the till the date till the tax has been actually paid to the government, the person has to pay the tax. Now, this is second consequence relating to interest. Third one is non-applicability of section 201. 201, assessing in case of default will not arise in the following circumstances. The Act has described four circumstances where the assessing in case of default will not be applicable. Those are, first one is search and seizure, section 132. Do you remember search and seizure, section 132, where the assessee has been searched by the income tax authorities and they have seized the book of accounts and other documents relating to the assessee, and the assessee is not available with any other documents relating the document book of accounts, and assessee is unable to calculate deduct the amount of tax within the prescribed time. Then in the situation he is waived. This section 201 assessee in case of default is not applicable. Second case is where the assessee, second case is what? Second case is where the yes, right. Second case is the assessee uh, has not deducted the TDS under the respective sections as per the decision or direction of any court, high court or high court. Then in that situation, if any retrospective amendment has been made of the law, or as per the direction of Supreme Court or the larger body of High Court, has passed any retrospective amendment. For that, the assessee has not deducted the TDS. In this situation also, assessee will not be considered as assessee in case of default. Third situation is where the assessee has not deducted the TDS against the payment that has been made to the non-resident who has the residency in the country or territory outside India, and it is not possible uh, country or territory outside India where the India has DTW agreement and it falls under Rule 44 capital H, and it falls under Rule 44 capital H for reference received from the competent authority within 2 years of the date on which the asset within 2 years from the date on which he has received the amount of assessment notice relating to estimated amount that he is liable to be paid, and the person will be the dispute will be settled by the MAP procedure, mutual agreement procedure, and he has given acceptance, and the appeal has been withdrawn against the Supreme Court or High Court under Rule 44 capital H from the date of communication of the resolution. In all these four circumstances, RSG cannot be considered as a in case of default. And this section 201 is also not applicable in case of where the assessee has furnished his return of income under section 139. Obviously, assessee here is the individual itself. And for individual, the due date for filing of return of income is 31st July of the assessment year. He has furnished his return of income, and not the act has not itself said that if the assessee has furnished his return of income, then the employer cannot be considered as assessee in case of default. He has to furnish his return of income within the due date, and along with in his return of income, he has to disclose the amount of payment that has been made by the employer to the employee, and he has to pay the respective amount of tax on that employee, and that amount of payment, then only that employer cannot be considered as assessing in case of default. He is exempted from treating him as assessing in case of default. Otherwise, he will be considered as assessing in case of default, and uh, he will be considered as assessing in case of default. And what are the due dates? What are the due dates for payment of period that has been deducted, and what are the due dates for furnishing of previous returns or furnishing of previous returns, and what are the penalties that will be applicable for the non-deduction of 3 years within the specified time limit? So let's talk about the due date for payment. Obviously, this is divided into two categories in respect of government employees, in respect of other employees. In respect of government employees, this is also two types. First type is if the payment has been made on the day, and they can pay if the amount has been deducted on the day, and they can pay the amount on the same day without any income tax allowance by the government authorities or government officers. And second one is they can deduct the amount of tax, and they can pay the amount of tax within 7 days of the following month along with the income tax amount. Second situation is in respect of other employees, in respect of other persons, there are two categories. First category is the payment related to March month, the payment is related to other months. If the payment is related to March month, the amount of tax has to be deposited to the government within 30th April of the following March month. In respect of other months, the tax has to be deducted the tax has to be deposited to the government within 7th of the month following the month in which the tax has been deducted by the assessee. Next we'll discuss about the TDS, punishing of TDS citizens. So, what are the due? There is one option that has been given by the acting officer. If the acting officer permits the assessee, then assessee can also pay the amount of tax in the form of quarterly installments. That is quarters. There are four quarters, right? June quarter, September quarter, December quarter, and March quarter. For June quarter, the due date for punishing of the paying of TDS that has been deducted is 7th of July. For September quarter, the TDS that has to be deducted by 7th of October. For December quarter, the TDS that has to be deducted by 7th of January. Obviously, for March quarter, the TDS has to be deducted by 30th of April. And this is available only for specified sections. There are four sections that have been specified. Section 192, Section 194B, Section 194H, Section 194, Section 194H, and Section 194 DA, Section 194A, Section 194D, Section 194H. For these four sections only, quarterly payment of tax is available. For remaining sections, quarterly payment of tax is not available. Second category is the amount of tax that has to be next is furnishing of TDS returns. TDS returns has to be furnished by the employer, by the assessee, quarterly basis on quarterly basis, and the due date for furnishing of return of TDS returns or quarterly basis. Obviously, what are the 30th for June quarter, 7th of July, for September quarter, 7th of October, for December quarter, 7th of January, and for March quarter, 31st of May, the due date for furnishing of TDS returns. If the assessee has not furnished the TDS returns within the time, there will be the penalty that will be available, obviously. Next category is what? Next category is rule rule 31 capital A, that is statement of TDS under 200%. Statement of TDS has to be statement of this statement furnished TDS returns has to be furnished in form 27, 26Q, 27QD, QD, QC, QD. So there are tax in respect of three sections. Section 194M, Section 194IA, Section 194IB. The TDS has to be the TDS has to be paid. TDS return has to be furnished within 30 days from the end of the month in which TDS tax has to be remitted within 30 days from the end of the month in which it has been deducted. In respect of two sections, Section 194M, Section 194IA, Section 194IB, and the TDS return has to be furnished in three specified forms: 27 QD, QC, QD, 26 QD, QD, QD. Okay, challenge statement of returns. Now, furnishing of tax returns, Section 200 of Section 3. This is divided into three categories. First category is the returns sections, the returns relating to Section 192 and 194C. For this, 24C is applicable. For sections relating to 193 to 196D, other than 194C, Section 26Q is applicable, and for sections relating to 190 for non-corporate, non-resident, and ordinary company and resident other than ordinarily resident, Section 27Q is applicable. Now, penalty that will be available for TDS returns, obviously you will encounter in penalty chapter. And there is Section 191. What is 191? The direct payment of tax. Direct payment of tax in the previous instance other than deducting from the source, from the income. So when you encounter this type of payment, here let's say there is not the case that all the incomes, all the payments that have been paid by the employer to the employee are going to be tax deductible. There are some of the payments where the tax is not going to be deducted. So where the income that is not going to be deductible, against which the tax are not going to be deductible, those types of incomes, the tax has to be directly paid by the assessee himself who is receiving the income. Next, Section 191 of Section 1 taxes. Section 191 of Section 2 tells what? Section 191 of Section 2 tells about the tax that is going to be paid on state equity shares, specified securities which are provided by the employer at free of cost or concessional rate. So the section is like this. The tax has to be paid by the person within 14 days from the earlier of the following days. What are the dates that have been prescribed? There are 3 days that have been prescribed. First date is 48 months from the end of the assessment year in which the special securities have been issued. Second date is what? Second date is the date from the date on which the transfer of sales or sale of special securities within 14 days. Now, third one is from the date on which the person ceases to be the employee of the sister employer from the date on which 14 days, the person has to pay the tax on the specified equities or city equity shares that are provided by the employer free of cost or conditional rate. Employer will be a startup eligible startup for eligible startup section 80 IA will be applicable reduction that is available for eligible startup. Obviously, three out of 10 assessment years, out of 7 assessment years, 3 assessment years, income will be available as reduction exemption. Obviously, reduction can be claimed as reduction. Next, 100% reduction will be available. Reduction of tax export. Now will comes to actual sections. Reduction of tax export. Section 192. Section 192 deals with what salaries. Salaries obviously for salaries will be assessed under section 15 to 17. Section 15 is obviously charging section. What are the amount of payment that has been paid by the employer to the employees will be assessed in the hands of salaries. If there is no employer-employee relationship, then it will not fall under the tax salaries. If there is employer-employee relationship, then it is it falls under salaries. There is contract of employment, contract for employment. Contract of employment is relating to salaries and contract for employment is related to professional services. We use the tax has to be deducted under section 194 theory, professional services. So you have to be very careful. If there is contract of employment, contract is there, then only whether there is contractual relationship between employer and employee, then the only tax has to be deducted. Otherwise, tax is not going to be deducted. Next, whatever the amount of payment that has been paid by the employer to the employee is going to be where the tax has to be tax is going to be deducted. So here the under section 192 there are four items we will discuss. First one is who is the payer, who is the payee, what is the amount of rate of tax, what is the eligible amount against which tax is not going to be deducted, and what is the nature of payment? Nature of payment is obviously salaries, and payer is employer or deductor or payer, and paying is employee. Payer can be resident or non-resident. Resident means we will come to section who is considered as resident, either individual. Here individuals only will be employees, obviously, right? Individuals who is considered to be a resident has been disclosed under section 5 and section 6 of the Income Tax Act. Their scope of residence, whether he is a resident and ordinary resident, a resident but not ordinary resident, non-resident, and even B1, B2 conditions, A1, A2 conditions, then he will be considered as resident or not resident. And category, next, second one is what? Second is obviously if the person is non-resident, then he will be taxed under obviously non-resident taxation related subjects based upon the type of income that he is going to be earned. And here, in respect of payee can also be the resident and non-resident. Non-resident and non-resident. Next, third one is sorry. Third one is what is the amount of eligible against which tax is not going to be deducted. So tax is not going to be deducted if his total income or his payment does not exceed 4,60,000 rupees. That is basic exemption limit that is applicable for the assessee. Tax is not going to be deducted. And fourth one is what is the rate that will be rate will be rate in force. Rate in force is the rate as per income tax act rate as per DWA, whichever is lower will be the rates that are applicable to the assessee, or whichever is beneficial to the assessee is going to be the rates that are applicable to the assessee. So here one special point for salary is while deducting the tax, we will deduct along with surcharge and interest surcharge and such educational cess also. We will deduct the PDS. This is only specific. This is applicable for this is the special point in respect of salaries. Next, third point is here the tax has to be deducted at average rates that are applicable to that. Average rate of tax. What is the average rate of tax? Let us assume that assessee has the total income, say total payment that has been made to the assessee is 6 lakh rupees. For 6 lakh rupees, the amount of tax that has to be deducted, that amount of tax liability that is going to be arise is 5 lakh rupees, 12,500 rupees, and 1 lakh rupees into 20% is 20,000 rupees. 20,000 rupees plus 12,500, 32,500, 32,500 into 104%. So, wait 1 minute, I will take my calculator. 32,500 into 104% is 33,800. 33,800 is the amount of tax that has been arised for us divided by what is the amount of salary? 6 lakh rupees. 6 lakh rupees equals to average rate of tax is 5.63%. 5.63% divided by 12 months is what? 12 months into 100 equals to 0.4694%. This 0.4694% into 50,000 rupees is the monthly payment that will be made to the employees. So 23,472 rupees is the amount of tax that is going to be deducted against the employee, and remaining amount of payment that is going to be credited to the employee's account. This 23,472 rupees is going to be paid to the government by the employer. Okay, obviously, the thing is, here against the salaries, there is a point that one special point is that it is not that employee has an option. The option that has been provided that employee can opt for section 115 BAC. What is 115 BAC? 115 BAC is the optional tax scheme that is available for the employees. If the employee has intimated, there are two things. First thing is employee has intimated, employee has not intimated. If the employee has intimated to the employer about the optional tax scheme that is going to be opted, then the employer has raised the tax as per the rate prescribed under section 115 BAC. If the employee has not intimated about the optional tax scheme that is going to be opted under section 115 BAC, then employer has to obviously raise the tax as per the normal rates in force that are applicable to the associate or employees. Again, the special point is in respect of income, the associate has to disclose, employee has to disclose all the income that is available, for the previous year going to be earned for deduction of taxes. So, if the employee has not, there are two consequences: employee furnishes, employee not furnishes. If the employee furnishes, well good. Employer has to consider all the income. If the employee are not furnished any income, then he has to consider whatever the documents or whatever the source that is available with proofs available with him for reduction of taxes. So third thing is here the employer can also consider the losses that are provided by the employee also, but he cannot consider all losses. He will consider only house property loss, and other losses will be ignored by the employer. For remaining amount of expenses on the furnishing of proof itself by the employer will consider. Otherwise, employer will not consider. Next point is what? Next point is here employment in respect of multiple employers. If the associate, there might be situation that employee will be doing providing services under multiple employers. For example, for the first half of the financial year, he has to work for one company, and for the remaining half of the financial year, he has to work for another company. If there is the obligation on the employee to furnish the details to the employer about the previous employment, then employer will computing the amount of the tax that is applicable for the employee. He has considered the previous employment details also. Then he has arrived at tax in order to avoid the penal interest consequences that are applicable for advance tax. In order to save the assessee from the penal consequences of income tax, penal interest consequences, he has to furnish the details. Now, the thing is, furnishing of PDF returns, furnishing of PDF statement or statement of purposes and statement of profit in lieu of salary to the employee. It is obligation for the employer, but the obligation arises with the specific condition that those employees who are receiving salary of 1,50,000 rupees, more than 1,50,000 rupees, they will obviously get the statement in Form 12BA. For remaining employees, there is no obligation against the employer to provide Form 16. Obviously, employer will be providing Form 16. Form 16 itself contains the details of the particulars of purpose and particulars of profit in lieu of salary. Next point is here TDS has to be TDS. There might be situations where there might be a situation. Let me check. There might be a situation where the salaries can be paid in Indian currency, can be paid in foreign currency. If the salaries are going to be paid in foreign currency, then assessee is going to receive in foreign exchange. Then that has to be converted into the Indian currency at the average PTDR rate that is available on the date of receipt under Rule 26. He has to consider, has converted to Indian rupees, and he has to obviously deduct the tax at source. Deduction of tax at source will be done by the employer or assessee only after considering the relief under Section 89. What is the relief concept? Relief concept is simple. The thing is, there might be government employees, right? The government employees, sometimes government will be getting some amendments or some notifications or circulars where the salaries is going to be hiked or increased for government employees. And government will not consider prospective amendment, it will consider retrospective amendment. Retrospective amendment means what? Retrospective amendment means it will consider specified date. For example, 26th August, so 26th August previous 10 years and 26th August after 10 years, 26th after 26th August onwards, so this amendment is applicable. Then retrospective amendment of wages, all the previous amount of wages that has not been received by the assessee will be received by the assessee as arrears of salary. This arrears of salary, for example, the assessee he has rendered a service of 20 years and retrospective amendment has been made for 20 years and he has received the arrears of salary of 2 crores or 3 crore rupees. Obviously, 2 crore or 3 crore rupees cannot be taxed on the assessee with higher slab rate because this is arrears of salary which has not been taxed in the previous years. So, the income tax department has provided a relief to the employee or assessee under Section 89 subsection 1. This relief concept has to be considered by the employer then only after considering the relief under 89 subsection 1, he has to deduct the tax under section has deduct the tax. Now disclose the disclosure of obviously income and house profit loss. This has already discussed. Next, employer is going to be paid the amount of tax on non-monetary purposes is also already obviously discussed. And the next concept is there is no tax that is going to be deducted against partner salary. So partnership firms, it is quite interesting that whatever the amount of payment that has been made by the partnership firm to the partners is claimed as expense against the PGP income. And there is no employer-employee relationship between the partnership firm and partner. Okay, those two are separate legal entities, but there is no contract of employee-employee relationship. If there is no employer-employee relationship, what are the amount of payment that has been made by the partner to the partnership firm to the partner will not come and fall under the head salaries, and no tax is going to be deducted against the salary that has been paid by the partnership firm to the partner. Next, there is a specific case law that has been prescribed, ITC Hotels versus Income Tax Department, Supreme Court judgment. There is a judgment. What the judgment says? The judgment is simple one thing. Any tips that are paid to the employee by the employer are not going to be taxed under the said salary, and it will be taxed again in the hands of employees under income from other sources. These tips, what is the nature of tips? That's the nature of payment. The nature of payment, these tips are not the obligatory payments. These are voluntary payments that are paid by not the employer, but paid by the third person or customers of the employer. Customers of the employer are going to pay the tips to the employees, and these are routed through the employer. These are not directly paid to the employees are routed through the employer. Employer is under fiduciary capacity of passing of payments that are received from the customers to the employee. This will be taxed under income from other sources, so no TDS is required. If it does not fall under the head salary, no TDS is required to be deducted against these payments, even though these are paid from the credit card bill also. These are not going to be profit in lieu of salary, and this will not fall under Section 17, and no TDS is required to be deducted against these payments. Second one is, there are this itself salaries. Section 192 salary is itself different. Section 192 capital A. Section 192 capital A deals with what? Section 192 capital A deals with two things. One thing, that is tax on the premature withdrawal of provident fund. So If the SSE has withdrawn the amount from the provident fund premature without before its maturity, then tax has to be deducted. So, who is the payer? Payer can be an employer, he can be a provident fund, he can be a trustee. Who is the paying? Paying the employee, resident employee, obviously. And what is the nature of payment? That is premature withdrawal of accumulated balance in the provident fund. What is the rate of tax that it will be deducted is 10%. There is no surcharge, there is no health and education subsidy. And what is the limit that has been prescribed is 50,000 rupees limit. So if the amount of premature withdrawal is less than 50,000 rupees, no tax is required to be deducted. If the amount is more than or equal to 50,000 rupees, then obviously the tax has to be deducted. Premature withdrawal, obviously 50,000 rupees has been prescribed. I think so. Yeah, 50,000, 50,000 rupees, 50,000 rupees has been deducted. Now, two things. First thing is premature means we have already understood. Now, provident funds. Under income tax act, there are three types of, not under income tax act, generally there are four types of provident funds. First one is unrecognized provident fund, recognized provident fund, public provident fund, and private fund. Unrecognized provident fund, any contribution that has been made by the employer